This is Edward Talisi for the CQF Institute and Chelsea Global Advisors. It's 17th of April, 2015. I wanted to talk about a couple of things today from some signals that I use to time the market on a short to medium term basis. And I think today is a good day to talk about it because Friday here in the US and indeed in Europe and in Asia was a pretty heavy day in the stock market. So it looks like the S&P today is going to close down about 1.3%, the Dow a little more, about 1.7%. And this really follows on the back of some news overnight. So for people that have been following the equity markets in Asia, China has really been on a tear, and the policymakers there do what they always do when they see speculative frothy activity as they tighten up margin requirements. So the Chinese stock market took a bit of a sell-off today in response to a very strong run-up in prices. Secondly, we have more noise and turmoil coming out of Greece. As you know, the ministers of Greece are talking to the IMF and some of their other creditors, and it doesn't seem, at least as of today, that any progress has really been made. For me, the key point is that a default by Greece, if it does happen, and there's no certainty that it will happen, does not necessarily mean that Greece has to or indeed will leave the European Union or the currency union. So sovereigns, for many years since the beginning of history, have defaulted on their debt. And Greece, if they decide to restructure their debt or pay it back at less than par, doesn't necessarily equate with the Greek exit from the monetary union. So we're going to have to wait and see. Nonetheless, the combination of that news overnight and some mixed earning news here in the U.S. has led to, a bit of a sell-off here in the market. And for me, what I really wanted to talk about is if you think about when these sell-offs come, academics have historically tried to decompose the variance in returns between two factors. The first factor is the variance in current or projected cash flows, and the second variance is the change or the potential change in the discount rate. Now, if you think about those two various components, it would seem to me that variance in cash flows or projected cash flows is probably much more important than the variance in the discount rate, although not all the time. Certainly, if companies have trouble growing their earnings or growing their payouts, that's something that investors need to take care of. However, if you look about variance in the discount rate, we can further decompose that into two additional factors. Firstly, the discount rate reflects the risk-free rate, U.S. Treasury bill or a German T-bill or a Japanese T-bill, which pretty much is close to zero right now, plus a risk premium. Now, we know that the risk-free rate component of the discount rate very, very rarely changes, and if it does change, it changes by a small amount, and expectations can make it change by more. But certainly over the last 6 or 7 years, the risk-free component hasn't changed all that much, which really means that all the change is held in the the risk premium component of it. So if you look at today's price action, and I think today's price action is very interesting, I don't think it's a cash flow variance problem or issue. So companies will continue to spend and invest and employ as they always have been, and people will go out and do what they normally do. So I don't think there's a really question over the future growth of earnings and dividends based on today's price action. Nor was there any change in the fundamental estimation of the risk-free rate. So it all has to be about the risk premium embedded in the overall discount rate. Now, if you believe that, I would say that if the sell-off continues and you believe that it is a change in the risk premium part of the discount rate, it's probably a good opportunity to buy because the risk premium piece of it is time varying, and the situation that led to a rise of it today will probably correct, and it may be a good opportunity to buy. That's certainly how I look at it for my own account. The second thing I wanted to talk about today, given the market sell-off, is that it's always important to have a diversified portfolio, and all the classic empirical and academic evidence supports that. But what I noticed when reviewing quarterly returns is that the most widely held and popular emerging markets ETF, which is Vanguard's VWO, had a huge gain over the last 30 days. It's up about 11%. Now, all the experts and consensus opinion says stay away from emerging markets when two things are happening. Stay away from emerging markets, one, when the Federal Reserve is either tightening policy or they're less generous than they have been, and that's certainly the case with tapering and talks of rate hikes. And two, stay away from emerging markets when the U.S. dollar is appreciating, and that clearly has appreciated by 20 to 30% over the last 6 months or so. Nonetheless, over the last 30 days, this VWO has appreciated smartly, and for investors that had a small allocation to emerging markets, like the literature tells you should, enjoyed a really nice gain. Now, it's easy to find out why VWO had bounced so highly. It's simply because that the ETF has about a 50% allocation to non-Japan Asia in the portfolio, which basically means China. So this small emerging markets fund did very well based on the price movements in China. Now, the third piece that I'm going to talk about, another signal that I think is interesting to look at, is simply the term structure of the VIX. If you looked at the VIX before today, the spot price of the VIX was about 1260. It was close to it's been over the last, close to the low it's been over the last 3 or 4 months. So it's very low. But the term premium, meaning the futures prices on the VIX a couple of months out, are still pretty high. They're closer to 15 and 16%. When the term premium is that steep, it sort of suggests that there's a lack of hedging appetite in the spot market, which sort of means that people may be overly complacent and it may be ripe for at least a short-term sell-off. So I fully realize that the signals coming out of the discount rate decomposition and what I'm talking about, the term structure of the VIX, could be contrary to one another. Nonetheless, I do think they're really good signals to think about your own trading and how you're going to position. We're going to have to wait a couple of weeks to see how earnings season plays out here in the U.S. However, my own opinion is nothing fundamentally changed today, and we should still expect to see the S&P market return what it tends to return each and every year on average, which is about 7 to 10%. For the year, the S&P is basically flat after today's action. Thank you very much for watching. Please check out the website for the CQF Institute and my own website at www.chelseaglobaladvisors.com.